This video will be a complete masterclass on what drives share price growth. And we will take this example with Fair Isaac, FICO. You probably know this company. They do the FICO scores in the US. And this is a great company that has grown a lot. And full disclosure, I used to own this company and I sold at the top. So made a lot of money on this one. And I will show you the story how this company generated a ton of value for its shareholders. So it will be packed with a lot of value today. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. Also thanks to investing in FICO, Fair Isaac. So in this video, I will show you all the components, the revenue growth, earnings per share growth, the buybacks mechanism, so you understand how this company generated a lot of value for its shareholders. First, there is a little bit of text. This is this graph from Long Equity. You can follow them. They generate great graphs, great tables like this one, and I will comment on everything they say. Operating leverage, cash conversion, share buybacks, and multiple expansion can all work together to boost revenue growth into even higher share price growth. This example is from the credit score company Fair Isaac. Notice how their growth rates increase as you move from revenue to share price. And let me put my face at the left so you see very well what is happening. Okay, so this is a table from 2013 to 2022. So not the latest data, but you will understand my point. And don't worry, the second part of this video, I will show you, I will play around with some metrics on Stock Unlock and on FinChat, so you will have a better view on what is happening with the stock price of FICO right now. So I will start from this analysis from Long Equity and continue, so you will have a ton of value. So you have this table with the past 10 years, with 10 years of data, and you have the revenue for 10 years, gross profit, operating profit, so EBIT, net income, free cash flow per share, and the share price. You see that for 10 years, between 2013 and 2022, the revenue has grown at a 7% rate. That's a CAGR of 7%. CAGR, compound annual growth rate. It's okay. It's not spectacular, but that's very important because that's the foundations for building this big capital allocation flywheel. If you want to become a better investor and improve your performance, I have a coaching program. More on that later in the video. If you don't have a growing revenue, you can't do that. If you are a business right now and you don't grow your revenue by mid-single digit growth rate, you can't operate the same way that they did. So now you start from a revenue growth rate that is 7%, very well. And they have improved efficiency a little bit because their gross profit has grown at a CAGR of 9%. What that tells you is the difference between revenue and gross profit is the gross margin. What that tells you is the gross margins improved for 10 years. And I can show you the proof of what I'm saying. If you go on Stock Unlock, by the way, Stock Unlock, great website. You have a discount code in my description if you want to use it cheaper. If you look at the gross margins between 2013 and 2022, here we go, roughly speaking, it has gone up from 69% to 78%. So that's a big change. You have 10% improvement. That 10% improvement resulted in a better growth from from gross profit. The same thing can be said for operating profit. The CAGR, compound annual growth rate, has been 14%. Now this company that started with 7% growth rate is slowly starting to become a growing beast. You don't have a lot of companies that can grow 14% per year their operating profit. And the same thing can be said about their operating profit. Look at this, between 2013 and 2022, here we go, the EBIT margins, operating margins, went from 22% to 40%. So you have a huge huge margin expansion over there, much more than the gross margin boost. Yeah, so that can tell you one thing. The gross profits improved because you have a little bit of efficiency for their cost of goods sold, so that's the gross margin. But the big margin expansion was due to the SG&A cost or pricing power, this kind of stuff. So now you had a difference of gross profit. Let me think out loud really quick. That went from 69 to let's say 79, so 10% increase in gross profit. This 10% goes back on the balance sheet, on the income statement, to operating profit. So on the same timeline, that should be minimum 10%, from 22 to 32. Maybe I'm not very clear. Okay. If you had the same gap from gross profit margin of 10% to the EBIT margin, you should result in 10% gap in 10% gap. 10% margin expansion to 10% margin expansion for the operating margin. But operating margins are growing by more than 10%. So you have even more efficiency from the operating expenses, operating revenue, operating cost, etc. So if you only had a 10% improvement that just went from the gross margins, you should have an operating margin that should have gone from 22 to 32, around here. But it went even higher. And now that's even higher and higher and higher. So that's just wonderful margin efficiency here. So you have efficiency for all the costs, actually. That's a beautiful flywheel that FICO has had over the past 15 years for this business. By the way, if you want to outperform the market with a proven investing strategy, I've created a free guide to show you how to do it step by step. Just click the link in the description to get instant access. Now you can continue to increase this efficiency. If you look at the net income over 10 years from 2013 to 2022, it has grown by 17% per year. The CAGR, compound annual growth rate, is 17%. Now we are speaking about big numbers. So you continue to have this little bit of efficiency. And if you look at the net margins, same thing between 2013 and 2022, you have a big margin expansion from 11% to 27%. Margins have more than doubled for 10 years. It's not something that you see often. And I can tell you why, because I've been a shareholder of this company. So basically, this company generates score, right? FICO scores in the US, very high margin. They do software and they do score. And it turns out that in the past, it was 50% of their business software, 50% is score. Score is a business segment with very, very high margins. And before 2018, this company couldn't raise the price of its score, okay? Of the scores they provided for businesses, or for individuals, sorry. When you have a mortgage, you have a score in the US. If your FICO score is high, banks will give you the money you need, the mortgage. And if your score is low, people will hesitate, will think twice before giving you a loan, basically. And before 2018, Fair Isaac had a regulation. They couldn't increase the prices of their scores. And since 2018, this regulation changed. So you have an untapped potential with the scores. And this is exactly what the management did. So they increased progressively the prices of their scores. And because the FICO scores are so important to the US economy, people paid the increased prices. It's only a couple of dollars, so it's okay. If that's only a tiny, small part of the mortgage application when you have for a new loan. So actually, people didn't mind. So they continue to increase the price over and over again. So you see, you have this big increase in profitability and efficiency since 2018, 2019 because of this. So look at this, the operating margins continue. The operating margins were increased a little bit, and then boom, in 2019, everything exploded to the upside. This is immense pricing power. And I bought FICO because of this, okay? Because of this phenomenon that in my opinion, was very strong and will continue to be strong. Okay, let me go back to this table. This is your net income. What do they say? Faster net income growth than revenue growth requires operating leverage, signaling that the company is becoming increasingly efficient. I have told you the reason why they became more efficient. Better pricing, better efficiency. It's a software company after all, so they have this economics of scale. The costs are rather fixed and the pricing went up and up and up. So the margins went up and up and up. It's more efficient. Now, if you compare the net income growth of 17% to the free cash flow growth of 18% for 10 years, you see free cash flow is a little bit better. This difference, faster free cash flow growth than net income growth, requires good cash conversion, suggesting it can efficiently manage working capital. Not very important on this table, just to let you know that FICO is an extremely cash generative business, generating a lot of cash. The free cash flow margin is immense, and the same way you had a net margin that went up. I'm showing you the graph from all-time highs like for the past 20 years. And if you look at the free cash flow margin, same thing. It went up massively. So the company generates a lot of net income, a lot of revenue, and a lot of free cash flow. Now, this is where it's important, and very few companies have followed this path. Now this will turn. Please be focused here. There is a clear difference between the free cash flow growth of 18% and the free cash flow per share growth of 22% for 10 years. This is big. This is the moment FICO becomes one of the best stocks you could have in this market. Faster free cash flow per share growth than free cash flow growth requires share buybacks. The only difference between free cash flow and free cash flow per share is the per share metric. So how do you play around with the per share metrics? You can either dilute your shareholders, you increase the denominator, you increase the number of shares, or you do the opposite. You use all the cash flows the company generates and you buy back your own shares. You do buybacks, you repurchase your own shares. And in the past, especially in 2021, 2022, the company did a lot of buybacks. So they took advantage of the volatility on their stock price to increase massively the repurchase of their shares. So only this move of capital allocation increased the growth from 18% growth to 22% growth. This is huge. Not a lot of companies can do this. Some companies are driven by ego, hubris. They want to grow better and they make huge acquisitions. It takes a lot of discipline to not follow the acquisition path and to just follow the earnings per share metrics, the free cash flow per share metrics. It takes a lot of discipline to think on the per share metrics, and not a lot of companies do it publicly. So only this increased your returns by 22%. And now let's look at the share price. If you like this content and you want to become a better investor, I have a coaching program. In this program, I will teach you the exact method that helped me generate 25% per year for almost a decade, using a unique, structured framework you can apply right away. In this program, you will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, and how to build a winning portfolio. And you won't be doing it alone. You will get my personal guidance to help you at every step, and you will be part of a private community of serious long-term investors. Click the link in the description to have more information. You will get a short video that explains how the program works. And if you're ready, you can apply to work with me directly. The share price for 10 years has increased by 27%. More than this. So, faster share price growth than free cash flow per share growth requires multiple inspection, as it was fairly valued by the market. Stock prices in the very long term will follow earnings per share, EPS, or free cash flow per share. Now you see that the share price of FICO has gone up more than the free cash flow per share. My opinion is it will revert back to the free cash flow per share growth. And I will tell you exactly what is happening. Because if you look at 2013, Actually, that's a little bit above, but a little bit below, but that's not important. If you look at the past decade, the price to free cash flow of FICO was in the 20, 30, it went up a little bit. And if you look at 2022, it went up in the 40, right? So you look at the past. Actually, I can show you on Fair Isaac. I can show you on this one. Now, no need for this one. It will be clearer for you. FICO. No, this is for after on the video. Please don't spoil you. Don't look at this. I will look at the price to free cash flow. Price to free cash flow for this company. From 2013, yeah, let's use the same timeline. It's the same, but okay. Okay. Very well. Very well. In 2013, the price to free cash flow for Fair Isaac was roughly 18. What do you have? 18, a little bit below, before 15, 18, 20-ish, 15, okay? And in 2022, it was 25, 26, 25. Let me continue a little bit. And that's 2023 when it exploded. So it ended 2022 with a price to free cash flow of 30. So roughly speaking, you start from 17 and you end up at 30. So that's a CAGR of 6%. Yeah, maybe you have to add the 6% to this. Do you have a 6% difference? No, you have a 5% difference, but you get the idea. So they could add a line here, price to free cash flow, and you would have seen 17 here in 2013, and you would have 30 at 2022, and you will have a CAGR of 6%. So actually, you can add, you can play around with the numbers. We are not exactly correct, but you get a roughly accurate number, a rough idea of how it's operating. The difference between 22% growth rate and 27% growth rate is the multiple, is the valuation. And now I will tell you something else. Because if you use token lock, you can see all these things. You can view as a percentage, which is way better. By the way, you can have an affiliate link in the description below to check either FinChat here or Stock Unlock and use discounts. Because I'm using them on a daily basis. These are the tools I use. These are the tools I tell my students, my clients to use. Great websites. And people that don't use these websites are literally burning cash, wasting their time. These are, I think, the best websites you could have. So you have this from 2013 to 2022. You have this view as a percentage, and I'm aware that you have a lot of lines, so maybe that's not very clear. The green you see below is the revenue, and then in blue you have the gross profit, and then in turquoise you have the EBIT, so operating profit, and then you have net income, free cash flow per share. What I want to show you on this graph is the equivalent of this table and the CAGR that is increasing as the efficiency grows. 7%, 9%, 14, 17, 18, 22, 27, okay? I have not shown you the share price. So I have excluded the share price on this graph. Here you go. You have a revenue that is going up 7%. Gross profit, 8%. Oh, it shows 9%, but it's roughly the same thing. EBIT going up 40%. Net income, 17%. Free cash flow, 17%. Free cash flow per share, 22%. We are roughly in the same numbers that are given in this table. Visually speaking, this is what I wanted to show you. Visually speaking, this is what it looks like. The revenue is going up by a little bit. This is in green. Okay, going up 6% per year. And then as you become more efficient, it's becoming more and more, is it a good angle? What's the angle for this one? Becoming increasingly vertical, and you have better and faster growth over time. And if you want to add the stock price here, you have this. So to answer your question, how is the stock price influenced by the fundamentals? Here you go. And now you see if you add the stock price, you have a stock price that went a little bit higher than fundamentals. If you have the same timeline from 2013 and 2022, you see that the free cash flow per share in purple, You know what? Let me remove all the stuff. Net income, EBIT, you have understood this. Let me remove revenue, remove gross profit. Here we go. You have the free cash flow per share growth. You can also use the diluted EPS, earnings per share growth. That's the same thing. My goal is to tell you over the very long term, the stock prices follow earnings per share, free cash flow per share. So now you see the green and the pink. This is the earnings per share and free cash flow per share. On average, they follow the blue line, the stock price. Okay. And by the way, if you look at the very long term, you always this kind of correlation. Yeah. The only change is the multiple expansion. You see that more recently, the blue line, the stock price, has been going up more than fundamentals. What does it tell you? It tells you that you have a multiple expansion. The price to free cash flow has expanded. This is the only difference. And I'm here on FinChat. By the way, also great website. You have a discount code in my description. I think you have 2 weeks free without any credit card just to try it out and see if you like it. It's great. I use it on a daily basis. You have here the price to free cash flow for Fair Isaac, for FICO. This table, I just shown you from long equity, ends in 2022. What they don't tell you is that this multiple expansion continued. And in the past, you could have a price to free cash flow for this beautiful business. Price to free cash flow of 20. Price to free cash flow of 20, 25. Beautiful buying opportunity. When it was announced that they had infinite pricing power and they could increase their price of their scores in 2018, you had a price to free cash flow of roughly 25. You could buy an extremely well-run business with a price to free cash flow of 25. And then it went to a P ratio of 50 to 60, and then COVID happened to 30, and then the stock price dropped for some reason. You had some new competition. You can check Upstart at the time. This is not a video, but a full competitor analysis, but you had some competition and some worries about Upstart. Full disclosure, I bought here. I bought in April 2022. I personally bought Fair Isaac in April 2022, I think yes, at the price to free cash flow of 25, with an extremely good business model, with great efficiency, with great margins, with a free cash flow that went up 20% per year. And then guess what happened? You had a stock price that went up and went up and went up, and the price to free cash flow went to 30, 40, 50, 60, 70, 90 at the top, and now it is reverting back, and we have a price to free cash flow at 50, 60. I would say buying FICO Fair Isaac at this price is quite expensive. It's quite overvalued, so it's better to not touch the stock at this price. And when the price to free cash flow will come down again, if you have a reversion to the mean, it can be this year, next year, in 2 years. We have to be patient. It will be a great time to buy. So I will follow it, and I will gladly buy more shares. I sold on the way up, so I made a lot of money on this one. It was a beautiful investment. But in this kind of scenario, when you have this golden opportunity of a better efficiency, price matters. If you had bought FICO here, you would have lost money. If you had bought FICO here, the same moment I personally bought, you would have made a lot of money. And I didn't buy at the perfect bottom. It's impossible to pick the perfect bottom. I just thought it was a reasonable price. Look at this. You had the price to free cash flow of 25, but it continued to drop here and here to a price to free cash flow of 19, 20. So it can continue to drop. What is important is the fundamentals are okay, still growing in the right direction. The management knows what it is doing. And by the way, quick tip for you guys, we mentioned the difference between free cash flow and free cash flow per share, so the buybacks. The management at the time was very aware that the valuation was a little bit low, and they did everything they could to buy back their shares. And you can go back to the buyback yield. Here we go. So what is the percentage of the market cap that the company was buying back at the time? And you see that when the valuation became cheap in 2022, they increased the share buybacks accordingly. In the past, you had the buyback yield, so what is the amount of shares you buy back every year, or 4%, 4%, and then in 2019, 2%, 2020, 2%, and then the stock price dropped, the company became cheap, and the company increased the buybacks 5%, 8%, 10% to a peak of 16%. This is very smart capital allocation. And I was a shareholder at the time, so I knew exactly what I was doing. I followed all the reports, all the earnings calls, and the management was very clear on this topic. They said, we don't plan to make any acquisitions. We don't like dividends. We cut dividends in 2017, so we don't plan to dividends. But we see buybacks as the best opportunity for you to reward the shareholders and create shareholder value. It turns out that they were right, and they bought back a lot of shares when the stock price went down and the valuation was cheap. And now, after the stock went up massively and the valuation went up again, as I told you, the price to free cash flow of 30, 40, 50, they stopped and they completely reduced the share buybacks. This is very smart. And a management team that can be flexible with their share buyback program is great news for us shareholders. So I hope you like this complete masterclass on what drives share price growth. A lot of efficiency, good capital allocation, and multiple expansion. Before you go, if you want to work with me directly, you will find the link to my coaching program below. And if you're not quite there yet, you can download a free guide that explains the strategy I use to beat the market. Both links are in the description. Goodbye.